as per se usual, let's start out with your perceptions of the November employment report. Paying particularly close attention, U6 moved from 7.8 to 7.4 to 7.6. I found that up 0.2, very interesting. We also lost a little bit on the work week, but wages, especially year over year, still hovering at a zone we haven't seen since the spring of '09, up 3.1%.
Right. So I would say this is a mixed report. And while people thought it was a pretty good report, I think the couple of numbers that you just pointed to are significant. The wage growth is good. Obviously, the jobs headline number isn't quite as high as it's been. But again, always look at the last 3 months rather than the actual month that we're in right now. And if you look at the last 3 months, it's 170,000. We still need only about 130,000 to keep up with population growth. So that says that we're still recovering jobs. We're still growing at a rate better than what we need just to keep up with population. So that's good. The point that you made both about the U6, the discouraged worker unemployment, and also about hours, I'd say, are the most significant. I always look at hours, the weekly hours. That's down 1/10. As you know, 1/10 doesn't sound like much, but it's the equivalent of 400,000 jobs. So that's a big deal. Whether it will persist, I've seen this before in the past few months. We see it tick down and then it's restated, goes back up. But it is something to watch. It is a leading indicator, and I would say that's relevant.
You know, I look at the stock market and I see it's having a bit of a tough time again today. Interest rates, though, seem to have stabilized on the long end. Is there a feedback loop in this number or in the 3-month or 6-month trends that you pay close attention to in the employment space that Jay Powell and company should find interesting or will have any effect on their future policy for increases in the market?
Well, sure, and it goes both ways. As you say, a feedback is really what you want to think about. So, you know, my gauge for where we're going in the future is always the change in the S&P 500. That hasn't been spectacular over the past few weeks. That's going in the wrong direction. So that tells us that we're actually expecting, the market is expecting growth to decline. So what is the Fed's reaction to that? Well, you know, there's the feedback. The first feedback, of course, is that something we've talked about in the past. We believed, you and I both believed, I think, that we should have been at a more aggressive pace in terms of raising rates in the past. But unfortunately, we're not there now. So the question is, what do? You know, this is kind of being an hour late to somewhere you want to be. And then the question is, do you double your speed on the freeway? Probably not a good idea. So I think the Fed and Chairman Powell have to be looking at this right now. And when I see it, I would say, you know, this is something that they probably are going to have to think about a bit more cautiously. It's kind of unfortunate because the insurance policy that you've talked about them wanting to buy in the past, they probably haven't bought enough insurance. They're at a stage where they'd like to cash some of that in, perhaps, or at least slow down on buying more insurance. And, you know, they're kind of in a bit of a bind right now. But I would guess that they will slow relative to what they thought they were going to do.
You know, the big issue globally, of course, is that the rest of the world was supposed to do better, and the U.S. was leading that charge at the beginning of the year. But that global coordinated economic activity has diverged. And I really see a problem here, Ed. I mean, rates in Europe are in the mid-20s. We see that spread staying ever so wide between our 10-year. And policy, well, the ECB is going to end their program at the end of this year in terms of bond buying. But at these rates, with no insurance, there is a big risk of their policies backfiring, causing more erosion in our economy. Your thought?
Well, I agree. There's no question that it goes in that direction. In some sense, the good news is that we don't rely all that heavily on them. And I say the reason I say in some sense is I wish we were a bit more of a trading nation than we are. But if you look at us, you know, we have about 20% of our GDP consists of trade. If you compared us to, say, Germany, they have 70% of their GDP consists of trade. So we are not quite as heavily influenced by outside events as some of the other countries in the world are. That said, you know, it's certainly not a positive when you see Europe slowing down, when you see that they have run out of ammunition in terms of the kinds of things that they can do, probably to a bigger extent than
but Ed,
even we are in right now.
what about the capital side of the equation? What about the capital side?
Right.
You're right. When it comes to the economies of Japan, Europe, China, we could look at how much we trade and look at the comparisons and know we're not an export economy. But at the end of the day, capital seeks the most common denominator level, and it's priced globally like things like oil. And they are going to affect that. Your final thought.
Right. No, I absolutely agree. The big deal, though, of course, is the difference between our rates and their rates. And so when you're thinking about capital flows, that still works in the favor of the United States right now. Whether that'll continue, depending on what happens to the yield curve and so forth, remains to be seen. But we're not in as bad shape, I would say, as some of the other places in the world. I'd still be betting on the U.S. relative to the others.